A lot of people say, well, what about the threat of China's military? Chinese have not historically been aggressors. Remember, Japan and Britain invaded China. They didn't invade Britain and Japan. A lot of people say, well, what about North Korea and North Vietnam? Well, China definitely was supporting those nations, but they never possessed them, and they never invaded them totally and took them over. So the history of China is that they're not an aggressive nation. And then the last one that they say, well, what about communism returning and wiping out the stock market like they did years ago? Well, you know, if you look at history again with China, communism was the abnormality for the Chinese. The history of thousands of years, the Chinese were some of the greatest free market global traders ever. Remember, Christopher Columbus was trying to find an easy way to China because there was such a richness of their trade that was going on. So, you know, I don't think China's going to return to outright Mao Zedong communism again. I think they're quite happy with what's going on in their country. So a lot of people have compared this to the Great Depression and saying, well, if this is the next Great Depression, then, you know, history tells us that, you know, stocks are going to go down by 90%. Well, I will agree that there are a lot of similarities of what's going on in the Great Depression to today, and it's the only economic period of time that we have a strong similarity. In the Great Depression, all asset types deflated, and you had a tremendous deleveraging of the economy. I mean, back in 1929, people were using $1 to buy $100 worth of stock, and that was going on across many different segments of the population. The market was being propped up by tremendous amount of debt and borrowing to buy investments. And the same has happened in this situation, and both bubbles have been pricked, and both are deflating rapidly. So you see these hedge funds going into the markets and selling tremendously, and it's pushing the markets down. And this is very similar to the Great Depression. Banks going under, unemployment is rising, et cetera, et cetera. But there are tremendous dissimilarities. So let's look at them. First off, banks are going under, but they're merged into healthy banks, and all the depositors get back their insured cash. In the Great Depression, when banks went under, people's money went with it, and the people who had borrowed money from that bank were being forced to repay it. Number two, money supply, which is the money in your pocket, the money in your checking account, the money in your money markets, and your short-term CDs. Those are all kept track of by the federal government. They call it money supply. A healthy economy has a slow growth of money supply, but in this current situation, we still have a slow growth of money supply year over year. But in the Great Depression, money supply declined by 33%. So, you know, if we had $100 billion of money in circulation during the Great Depression, by the end of the Great Depression, we only had $70 billion of circulation. And again, a normal situation where you have $100 billion one year, $105 billion the next year, $111 billion the next year. And that's what still is going on right now in our monetary money supply. Number three, the Federal Reserve has been making the cash available to those in need both domestically and internationally. In the Great Depression, the Federal Reserve merely watched as liquidity dried up around the world. Number four, trade is still free internationally, though it is being hampered by lack of credit, letters of credit that importers and exporters need to trade with each other. During the Great Depression, they actually passed governmental laws that said you couldn't trade with each other internationally. Hopefully a new president wouldn't do that, but we don't see any sign of that from either candidate. Number five, taxes are still low, and we hope a new president wouldn't foolishly raise them in a time of economic pain, but there is speculation that one candidate would want to do that. And in the Great Depression, though, taxes were raised to balance the budget, therefore taking liquidity out of the economy and given to the government to balance its budget. So, you know, hopefully we won't see that. And number 6, the unemployed receive unemployment compensation, and both spouses are likely to work, minimizing the risk of no household income. In the Great Depression, normally only one person worked, and if that person lost their job, the family was totally impoverished. The question is not, are we headed into another Great Depression, but what are we headed into? I don't necessarily have the full answer to that question yet. Much of what the government is doing is unprecedented. Federal Reserve Chairman Ben Bernanke is a student of the Great Depression. He wrote his doctoral dissertation on the Great Depression and what the government should have done to alleviate the pain of the Great Depression. So, Mr. Bernanke, by chance, fortunately or unfortunately, has the opportunity now to implement his theories. I'm not saying whether they're good or bad. That's not what my job is. My job is merely try to figure out, well, what's it mean for the economy? Where is it going to head? What's going to benefit and what's going to be hurt by the policies that he's implementing? Our theory is, at this point in time, that he is going to devalue the currency, that we're going to see inflation in the future, that the dollar is going to have serious problems in the world currency markets, that he's going to have trouble trying to pull the liquidity in once this economy gets healthy again, and that you're going to have a couple more very serious problems in the future. And that's why we're every morning, 7:30 a.m., my investment team of 6 to 7 people are getting together and saying, what happened last night? What happened yesterday? What are we going to do today? Are there any moves? What do we think has changed, if anything has changed? And where do we go? I want to end with this. Our goal is to help lessen the worry and burden of money management. And in many ways, where we stand right now is not helping some of you to not worry about this. But I feel confident about where we stand. We have a tremendous amount of cash. We predicted a lot of this. We never expected it to be this bad. And we will keep you up to date if we think you need to make any changes. And every day we are making changes to the portfolio as we see fit. Our next likely response, as I say, this is a bull bounce, most likely a bull bounce as opposed to a bull move. And you may see us get even more conservative in the future. But as I say, I'll keep you up to date, and whenever I can do these videos, I'll be more than happy to do them for you. Again, they're not going to be very professional, but they will be what they'll be, and you can get our market assessment. So, with that, this is Drew Tignanelli saying God bless.